All right, welcome everybody to this installment, this Wednesday edition of the Rich Options Jerk webinar. We got a few things to talk about today. Obviously, we're in the thick of earnings season, and we've seen stocks respond well to good earnings. We've seen stocks respond poorly to bad earnings. We've even seen stocks respond poorly to good earnings. And that just kind of gives you a sense of how difficult it is to trade during earnings season. And just because of the way that we do things here at the Rich Options Jerk, this is not a time where you're going to see a lot necessarily an overload of trades. For those of you that were with us on Monday, I heard somebody on CNBC say something that was very, very profound. Here's what he said. He said, professionals react to what happens after earnings. They don't trade earnings. Why? Because earnings are completely unpredictable. Look at what happened to Facebook today. The initial reaction to the earnings report was negative. The stock was down. Now the stock's actually up. We see stocks that look like they had some good earnings, and then somewhere in the fine print, there was disappointment. So you have something like Google. But on the other hand, you have something like Boeing, which today blew the numbers away and was up huge. In fact, if you look at the Dow Jones Industrial Average today, because it's a price-weighted index, and the divisor is actually a multiplier because it's less than 1, if it hadn't been for Boeing, the market would have actually been down today. So earnings season is one of those things where you gotta be very, very careful. You gotta tread lightly. Have your stocks, your ideas already researched on your watch list, as we do here. Check them during the day or at the end of the day or whatever your discipline is, and make a note, as I do, of the earnings dates so that you know, hey, if something like, for example, looking at my list here, something like Disney, the chart is getting very, very constructive. If just at first glance, I would say, hey, this is starting to get bullish. Well, earnings are coming up on August 8th. Well, that's barely 2 weeks from now. So it's not something that I think it's worth the time or the risk to get into a trade and have some external number, some number come out that ruins the stock in the short run, even though in the long run the stock probably will behave very well. But again, we don't know. So we're already using options as a way to manage risk and get control of our risk. But at the same time, we don't want to walk into a buzzsaw. And in this case, it's a buzzsaw of uncertainty. Okay. The other thing I heard, which I actually read yesterday on another website, one of the services that I get, one of the professional services, and it kind of summed up exactly what's going on right now in the marketplace. In the course, we do put a lot of emphasis on option strategies that include selling. And two of the strategies are credit spreads. You sell an out-of-the-money call spread above the market, or you sell put credit spread below the market, like we did in the IBB a few weeks ago, and that trade is summed up, is recapped in our newsletter from a couple of weeks ago. But you have to make sure that one of the things that we talk about is you got to make sure that you get paid for the risk, because those trades, even though they have positive theta, they have very high negative gamma. And if the stock were to make an adverse move that is running up to your short strike if you have a call credit spread, or running down to the put strike if you have a put credit spread, those spreads can pick up value very, very quickly, because as the short option in the spread approaches being at the money, its delta is going to start increasing at a faster and faster rate, while the one that you're long, which you bought further out of the money, higher strikes for calls, lower strikes for puts, to protect you against disaster, is not picking up delta as much. So these spreads can actually work against you if there's a very quick adverse move in the stock. And unless you feel like you're getting paid enough, or you believe you're below a very strong support or above a very strong resistance, you got to be very, very careful. Now, the reason I say this is that I read yesterday something that I think in one sentence sums up the option trader's dilemma in this environment. Here it is. The current low volatility environment is a dilemma for option strategists with long volatility exposure to time decay and small underlying movement, while short volatility is too cheap to sell. So you're kind of caught in a bind, right? If you're a buyer, you have long volatility exposure. That's one of the reasons you're paying the extrinsic value, but you're subject to time decay. So even though volatility is low, you're still paying for that volatility. And that extrinsic value eventually will go to zero. However, if you're a seller with volatility low, you're not really getting paid enough. If there is an adverse move, volatility increases, you sold an option, you really didn't get paid a lot for it because it reflects the market's current opinion of the level of implied volatility, which translates into the option market's best guess of where a stock is most likely to go and where it's most likely to not go. But as we reinforce in the course, that is just the option market's opinion, if you will, at that exact moment. And if the stock starts moving, or the ETF or the index or whatever it is you're trading, it starts moving, what's going to happen is not only are you going to get the effects of the negative gamma, but because you have what's called negative vega, the extrinsic value will be, additional extrinsic value will be put into the option. So you kind of get a double whammy. Being short an option, you have negative gamma and negative vega. You do have positive theta. Well, under normal conditions, not expecting the stock to make a big move, and selling options at a reasonable level of historical implied volatility, not historic volatility of the stock, but somewhere in the neighborhood of an historically average or acceptable or common level of implied volatility, you would expect the stock to make a very rational type of move. But if the level of implied volatility is low, you're not getting paid for the possibility that the market's opinion or consensus opinion of the future volatility, in other words, the implied volatility will change, could go higher. And if you're short an option, that's negative vega, and that can really hurt you. So this is the dilemma of option trading in this environment, which is why you really haven't seen any credit type trades yet in the educational portfolio that we're starting to put together. This is only this third week, I think, that, well, there's actually the first official week that we're doing the webinars, but we've been practicing things for the last couple of weeks. So the point being that you've only seen that one credit spread, that the put credit spread in the IBB, the biotech ETF because the whole biotech market, after having broken out, pulled back to a very strong, what I thought was a pretty strong support level, and the premiums there were actually acceptable for what the kind of risk that I thought we were taking. So we collected 90 cents for a $5 spread. It was a three. You'll see it if you go back in the newsletters. I really don't want to go through it again, but it was a successful trade as the IBB rebounded and it's continued to go up. Now, that IBB might present itself again if it pulls back to a support level. But things are generally in a bull market, so you got to be careful about selling call credit spreads, because unless the stock is at the top of maybe a 3 standard deviation Bollinger Band and is starting to pull back, and the RSI is very high, I think you're putting yourself in a situation of unacceptable risk. Even though the credit spread is a hedged position, you got to be very, very careful about those things. Okay? So anyway, that is the story from an option premium standpoint. Let's get into the meat of what I wanted to talk about today. There is one type of trade that can be considered. It's not in the course, so there's a little bonus for you. If you want to play earnings and you think the stock is going to end up within a certain range, everybody thinks of that as an iron condor, but there is another type of trade. It's called the double diagonal. And what I started doing here is building one in Amazon. Now, the other day, I actually did do one in Google, expecting the stock to be within, I think it was about let me look up the actual strikes that we did. With the stock at around 990 or so, we were looking at the 1035 call on the upside and the 945 put on the downside. Now, what I'm going to do is I'm going to show you how to put one of these together using Amazon, because Amazon is going to be reporting. So the reason that you do this trade is to take advantage of the different levels of volatility in the options. Okay, if you notice right here, if we scroll down and we get close to the at the money, which is around 1052.5, you'll see that the level of implied volatility in these options is close to 51%. And that's very, very high for Amazon. Generally, Amazon trades in the 20s. So what's happening? Why is the level of implied volatility elevated in this case? Well, the reason that it's elevated in this case is because put yourself in the shoes of a seller. Are you going to sell options at the same level of volatility with earnings coming as you would when earnings weren't coming? Well, of course you wouldn't. Why? Because you needed to be compensated for the additional risk that you're taking if you're a seller. So the prices of options in the week, and usually the week or two after earnings, because the option market's pretty smart, it's not going to let people get away with it, trying to outsmart the system, right? You could say, oh, I'll just do next week. I'll just buy next week's options. Well, everybody thinks that too, so those levels of volatility are also elevated, although probably not as much, but they're still elevated. Anyway, what you try to do in a double diagonal is try to create something that will behave very similarly to an iron condor, but because the options are separated by time, it takes on a completely different behavior pattern. Okay, so you're selling options that have high levels of implied volatility in the short expiration. In this case, we're going to use Friday's expiration, and you have lower volatility in the options that you're buying. Okay, so where do we put the strike prices in this? Well, one trick that option traders know is that if you priced out with the stock at 1052.80, if you priced out the 1052, the at the money straddle, the value of that straddle should represent the limits of the expected range of Amazon after earnings. Why? Because if you're the seller of a straddle, you don't want the stock to move beyond your break-even points. So here, the straddle is about $21 for the calls and almost $21 on the puts. So let's call it $40 or $42. So the option market right now is telling us that it really doesn't expect the stock to move further than plus or minus $42. Well, that with the stock at 1052, that would put it close to 1100 on the upside and close to 1000 on the downside. So the first thing we do to create a double diagonal is we look for strikes to sell, you see it over here, that are going to be at those limits and maybe a little bit beyond so that we give ourselves a little bit of a cushion. So in this case, I use the 1100 call and the 1000 put. Okay, now obviously if we do that, we're going to get paid a ton, but we're not going to be protected in case the stock makes a big move. So what do? Just like in an iron condo, you buy protection. So in this example, which I haven't even finished yet, but I started, and you'll see what it looks like, we're buying the out of the money, further out of the money call, just like we would in an iron condor, but in this case, we're buying an October option instead of a July option. Okay, why? Because we're not going to have to pay as high a volatility level for that option. Okay, so that's going to be up here, you'll see right here at the 1110, right there. There's that option right there. Okay, now on the other hand, we have to buy a put below this one to protect us in case the stock collapses. Okay, and since we're doing a $10 spread on the call side, let's do a $10 spread on the put side. So we're going to buy the 990 put, and that would be this one right here. Okay, and there it is. Okay, so there's our double diagonal, and let's take a look at what it looks like. So we're going to go to the Analyze Trade, and there it is. Okay, if you notice, it has a very unique shape. Okay, right here, a very unique shape. Okay, the spread will cost you $39.45. Okay, now I'm using this example. I'm not going to expect anybody to run out and do this, right? I just threw this together, but so that you could see the shape, right? And this, if I got this down to a one lot, okay, right there, you could see that this trade could actually be, since it's going to be a very short-term trade, it could actually be quite profitable over a very wide range of prices. This blue line, which is the expiration date, if everything stays the way it is, meaning the volatility in the October option stays constant, and I'll get to that in a second, this trade actually has a break even at 985 on the downside, and it has a break even of 1126 on the upside. That's a pretty big range, right? 1126 is 70 points, so that's 70%. And on this side, it's 984, which is, what is that, 84, 16 plus 52 is 68 points on the downside. So you can see that this trade can make you money over a very wide range of prices. Now, the objective of the trade, obviously, is not to make a killing. You want the stock to end up in between those two prices, and then you take it off. Okay, why does it work potentially? Because the premium that you're collecting for the options you're selling is way out of whack compared to the volatility you're paying for the options that you're buying. Okay? So even though this costs a pretty penny, and again, I'm not recommending this trade, I'm just putting it together to show you what this looks like. You could see that this has the potential to make you some really decent money if the stock stays about where it is. We're talking about 600 bucks. Over here, it could be as high as $1,500, and over here in this construction, about $1,050. Okay, so it's very attractive. Now, there's got to be a catch, right? The option market is not just going to give you money. So there has to be something in here that we have to be aware of from a risk standpoint. Okay? And the risk is right here in the volatilities of the October options, right here. Right here. Now you see this is about a 23 and this is almost a 24 volatility. So let's go back to looking at our trade at the options that we bought and look at those volatilities and look at how sensitive our options are going to be if for some reason the level of volatility in the options that we purchased declines. Well, where do we see that? Well, in the course, we talk about Vega. Vega is an option price's sensitivity to a change in the level of implied volatility. So if we do our research and we go, hey, look, the October implied volatilities within the last 30, 40 days, they've kind of hovered in the 22 area. Well, what that would mean? That would mean that we probably wouldn't have that much risk of the level of implied volatility decreasing and hurting our profits, our profit potential, right? Because of our positive Vega. In this option, in the put, the Vega is a positive 170. So that's $170 for every percentage point. In the call, it's $190 for every percentage point. So that is $360 out of our profit potential if the level of implied volatility were to decline. Well, for every one percentage point. Well, that shows you that this trade, instead of making you $1,000, might only make you $500 or $600. And over here, if the implied volatility goes down a couple, 3 percentage points, here you might only make 1,000 instead of 1,500. But the part you really got to be aware of is the fact that these levels here, where you already believe that you had a break even, those now are going to be a loss at those prices. Okay, so you may have heard about this trade, you may have been wondering about this trade. Okay, it's a trade that can work very, very well, but you got to be very, very careful about the positive Vega that you're paying for the long options. Okay, now you can compare that to a pure credit spread, an iron condor. So maybe we just take a look at that. Okay, let's do this. Let's add a simulated trade. Let's do another one. Okay, so let's get rid of this. Let's get rid of this. And let's take a look at a very similar trade. Okay, but this time what we're going to do is we're going to sell the 1,000. We're still going to sell the 1,000 put for Friday, but instead we're going to buy the 990 put for Friday. Hold on a second. Let's get rid of this. Oh, hold on a second. We got to get rid of this right here. Hold on. Sorry about that. Whoop. I don't know what happened. Hold on a second. I don't know what happened. Hold on a second. Did we just lose this? Hang on. Okay, let's get rid of this whole thing. Uh-oh. Sorry, folks. I think we have a little problem here. Oh, we just lost our Thinkorswim platform. I think we just crashed. Hang on one second. All right, let's start this up again. Stay with me, folks. See if we can get this going again. If not, we'll just go to an alternative platform. The beautiful New York City skyline, ladies and gentlemen. So we're going to build, I'm going to show you the iron condor of this. If we can get back into it. If not, we'll go to another platform. All right, we're getting there. Enjoy the slideshow. All right, if this doesn't come up in a moment, we will have to make an adjustment. Okay, let's make the adjustment. And let me show you on this platform. This is a little different platform. Okay. Yeah, I think something happened to Thinkorswim. Thank God it didn't happen during the trading day. All right. So let's go into Amazon here. Okay, and what we're going to do is we're going to build the iron condor for this Friday so you can see how that looks. And one of the things about the iron condor is because you're buying and selling options with the same expiration, then you should have less vega, right? It actually should be slightly, you have a slight negative vega, which should be okay because we expect the volatility to go down. Okay, so let me build this trade for you. Then hopefully we can get back to Thinkorswim so I can review some trades with you. I think this was the 1,000. And this is going to be the 990 put right here. Okay, so let's take a look at this. Okay, what? So if we do a snapshot analysis of this trade, let's see. Let's edit this. Let's make sure we got the right thing here. Here we go. And here's what it looks like. Okay. So you got two $10 spreads out here. You're collecting $538, which you would retain if on Friday the stock ended up above the short put strike and below the short call strike. And then if the stock were to move up above that level, your maximum loss. Let's edit this ticket. Hold on a second. Up is 269. Hold on a second. It looks like it's actually calculating two of these. Anyway, the point is that if you did two of these, you'd collect $538. You would get to keep that money if the stock stayed between the two strikes. But if it moved beyond those strikes and it moved beyond the long strikes, you could lose $1,462. So you're basically collecting $270 with a risk of $730. Now, what you would do is you would compare that to the double diagonal because you would have that risk of the positive vega. So you have to take that into account when you make your decision. Now, in Google, I did do a double diagonal, and the stock did move to a really nice spot, but I underestimated the change in the implied volatility in the long options. So I bought this double diagonal for 19. I had to sell it for 18 and a quarter. Not a big deal. It's only a 75-cent loss. Okay, but still, that's the risk when you play volatility like that, is that if your long-term option is priced at a level of implied volatility that's still a little bit elevated, even though it is lower than the one you're selling, if that implied volatility were to drop, you would have risk there because of the positive vega. Okay, so that's what a double diagonal is. If you've heard about it, great. If you were interested in learning more about it, I just showed you. If you had never heard about it, you just saw it. It's not something you do a lot, right? Because those long-term options, if you don't get paid enough premium along the way, you've got heavy, heavy negative theta because you're long and out of the money call and you're long and out of the money put. So it's not something that you want to do just for the heck of it. There's got to be a good reason. Okay, let's go try to get back into Thinkorswim. Let me log back in here, and I apologize for this. All right, we're going to start over again here. Where's the login window? Please show me a login window. There it is. Here it comes. Okay, just bear with me for a few minutes, folks. And I'll show you some trades. We actually took off a bunch of trades yesterday because of earnings season coming up. And we put on a couple of new trades in the educational portfolio. All right, here we go. Give me 1 second. I'm logging in right now. All right, here we go. All right. So while we're waiting, let me show you what we did here. The first trade that I'm going to review with you is a bull call spread in eBay, which we picked up yesterday because the stock on our technical algorithm did show us a confirmation of a buy signal on the weekly and daily chart and a pullback right to support. So how did we play that? I'll show you that in a second. So that's a September bull call spread. Now, again, because premiums are the way they are, a bull call spread actually was very attractive in this case, and I'll model it for you, and you'll see what the potentials are. And the other one we did was a diagonal spread in JP Morgan because the stocks, even though we probably are a little early in this one, the stock was noted after earnings, right? You notice how the stock ran up, actually pulled back after earnings, right? Remember what happened to the banks, and then started spiking up yesterday. So with the stock trading against this resistance, but still being in a bullish mode, what we did there was a diagonal call spread where I bought the long-term call. It happened to be a September 90 call, and I sold this week's 93 call. Okay, and I'll show you that as soon as it comes up. Okay, because this really embodies what the Rich Options Jerk is really all about. We're trying to teach you to go from an idea in a stock to a trade that makes sense for what you're looking at and the level of premiums. Okay, now I'm going to summarize these in the weekend newsletter, but we did get out of a UPS diagonal call spread which it was successful. Again, this is for educational purposes only, and because UPS is reporting earnings tomorrow after the close, and we also got out of a Lyondell Basel call diagonal spread because it's reporting on Friday before the opening. Yesterday, we also got out of our Home Depot put diagonal because the stock had pulled back, which is actually good for a put diagonal. If the stock drops precipitously, that's actually not good because, as I said before, the short option since it's got a short expiration, has some very high negative gamma. So if the stock goes down too far too fast, what's going to happen is you're actually going to be scrambling a little bit to try to manage that short put. Well, fortunately, we had rolled this option a couple of times, and we got a pullback in the stock. And it turns out that even though we started with a cost of our trade of $2.50, and we unwound the trade for $2.61, which is only an 11-cent difference, we actually ended up with a 64-cent profit. And the reason we had a 64-cent profit is because while we were rolling our short put, even though we were kind of chasing our tail a little bit because the stock was dropping, we did get the cost of that trade down from $2.50 down to $1.97. So when we eventually sold the spread for $2.61, that was not an 11-cent profit in terms of return. We actually ended up with a 61-cent profit. Okay, and I'm going to summarize this and the other trades when we get to the newsletter this weekend. On the UPS, it was a very similar situation. On July 3rd, we started with an average cost of about $2.93 on our diagonal spreads. But because of the rolls that we did, even though we sold one of the diagonals for $3.58 and the other one $3.42 and the other one for $2.51, we actually ended up with a nice profit. Why? Because we had collected an additional 45 cents, an additional 50 cents on the two rolls that we did. And we sold the option that we eventually covered at $1.21. So when we bought that option back for $1.48, we actually only lost 20 cents on that option. So this is going to all be spelled out in the newsletter this weekend. So please pay attention, because it really does embody the concepts that we're trying to put forth for you folks in the course. These option strategies are very, very powerful, but you do have to go through the course to understand how they can have this potential to increase substantially the likelihood of you having a profitable trade. Okay, so let's go to this eBay trade right here. In the eBay trade, which we did yesterday, when the stock was trading at $36.34, if you remember the chart, the chart actually showed us that it had pulled back into a very, very strong area of support. And instead of just going out and buying the September 36 calls for $1.31, which we were in our rights to do, as I say, the option police were not going to arrest you if all you do is buy the calls, it would make some sense to explore doing a vertical spread, a bull call spread, not a diagonal spread, because there's just not enough premium in the short run to warrant having to chase the stock all over the place if all of a sudden it started going up, as it did actually just today. It was up 72 cents. That algorithm is very, very powerful. But it's not only finding the things to trade, it's finding the right strategy. Okay? So the bull call spread in this case, from my vantage point, had the right balance of risk and reward because of the level of premiums. Looking at the chart of the stock, here, let me put this back up here. Let's go back to eBay. You'll see what I'm talking about. Right here. And there you go. So looking up in here at this 38-ish level, right there. Not going to be too greedy. If it got to 39, that would be great. I'd be very happy. But remember, part 39, that would be great. I'd be very happy. But remember, part of the rich options jerk mantra is that we want to make a reasonably attractive profit if we're right. We don't want to swing for the fences, and quite frankly, we don't want to have to be extremely right. Right? In other words, I don't have to pin all my hopes on making money about being exactly right about a move. Yeah, does the stock look like it has the potential to get to 39? Is it only $2 away from the current price, which is what, 6%, even less than 6%? Yeah, the stock can move $2 in the next couple of months. Of course it can. But I don't want to be I never want to put myself in a position where the stock has to move to a certain exact price in order for me to make money. So hence comes the bull call spread. As I said, the stock was 36.34, and we bought the 36 call for $1.31, sold the 38 call for 47 cents, which gave us actually a net cost of only 84 cents. Now, why is that attractive? Well, from the point of view of this bull call spread, it's a potential $2 spread. Well, if I put up 84 cents and I can get back $2, that's a potential profit of what? $116 on my $84 per spread. Very, I think, quite acceptable, and only needing the stock to get to 38. We don't need the stock to get to 39. Furthermore, the break even of this trade at expiration is only $36.84, and the stock was already $36.34. So if the stock were, for some reason, to bounce around between 36 and 37-ish, chances are pretty good that we're going to come out at a break even or with a very small loss. So that's how I got to this bull call spread. However, what really got me was when I went over here, and it'll come up in a second. Let me clear out all this. Oh, here it is. It's right there. Here it is. So when we look at the risk profile, I want you to understand something that's very important to us here at the Rich Options Jerk. Let's get rid of that. Whoop, we don't want that. Let's get rid of that. Okay. Let's go to eBay. Okay, there it is. Okay, so what do you notice? You notice the blue line, which is the at expiration line, and you notice the purple line or magenta line, which is today. Okay, so if we're looking at the upper end of this range being 37, 38 up here, see right here, 37 and a half, 37.60, with maybe the stock getting to 38. One of the things you want to do with your simulation program is you want to be able to look at a certain price, let's say 37 and a half. Let's say it gets back to the old highs. Doesn't even have to get super, super high. Let's say 37.55. Okay, what this is telling us is that this 5-lot trade, and of course for a 1-lot you would divide by 5, if the stock went to 37 and a half tomorrow, we should expect to make about $170, $175 on this trade. Right? Well, the whole trade only cost us $400, a little over 400, 420. Well, that's not bad. That's a 40-some-odd% return in a couple of days. I'm not averse to that. I won't give everything back. But if it's that price on the expiration day, you can see that the profit jumps up to $357.88. So what is this telling us? What this is telling us is that if the stock were to get to 37 and a half on any day between tomorrow and the expiration day, we should be able to make at least $170 to $175 on this 5 lot. Okay, which is about a 40%. Right, it's about a 40% return, because maybe even more, because the trade cost us 84 bucks. And now, if the stock were to move higher, let's say up to 38 or even 39, now we're talking. Did this thing just freeze up again? Look at that. Oh, here it is. It's just a little slow. Okay, so here we are with the stock at let's make sure we got this. Okay, there we go. Now it just says that my screen sharing was interrupted, and it's reconnecting. Okay, so it says that we're back sharing monitor too. Okay, so if we're looking at the stock going up here into the 38.40 area or so, now we're looking at a much higher profitability. See, we're up in the 270 some odd dollar range. So we know that if the stock gets to 38 and change on any day between now and the expiration day, then we should be able to make at least 270 bucks on this. Now, the cool thing about spreads is that if the stock were to drop sooner rather than later, we actually can get out with a lot less loss. So that's the benefit of the bull call spread. That's why the bull call spread is so cool. We really can help our own cause a little bit and still make some really, really nice money if the stock moves in our direction. But if for some reason it would break support level and we would want to get out, you could see that the risk is pretty low at this point right over here. Okay, so let's spend a moment and let's look at the JP Morgan trade so you get a sense of that. Okay, so here's what we did on the JP Morgan trade. Let's add a simulated trade there. Let's go to our JP Morgan, JPM, right there. And let's get rid of that. And let's look at the risk profile on that trade. Okay. So let's get rid of this. And here you can see what we did here. We bought the September 90 call for $4.15. And we sold this Friday's 93 call for 58 cents. Now, I'll grant you that the volatility in the near-term option is a little bit low, but this long-term option is pretty reasonable. So we did this when the stock was 92.98, and we pocketed 58 cents. Now, it looks like, even though today's Wednesday, it looks like we're probably going to keep that premium because the stock has backed off to 92, which will give us an additional opportunity to collect more premium and continue to lower our risk, just like we did with the UPS, just like we did with the LYB and the Home Depot. Okay, this is the kind of trade that you're going to probably see most often here with the rich option share. Okay, it's a total return strategy for managed risk where you can try the goal is obviously the total return, but as the stock moves around through time, and you know we're big proponents on that, what we're trying to do is to collect premium to lower the risk so that we don't need the stock to move as much. In fact, the stock could even be lower than when we start because our net cost would be so low that we could unwind the trade at a price that relative to our starting cost was a loser, but because we've been able to collect premium, now we actually have a winning trade. Okay, so we started the trade when the stock was 92, 98. Probably got a little too excited there. The stock backed off, especially with the Fed today saying, we're kind of maybe going to cool it on interest rates. Stock backed off. But the chart, the technical picture is still very, very strong. So could we get a pullback into the, 90 handle? Yeah, it's possible. But we still have that 90 call for September. So we've got a month and a half to go. And in a month and a half, we can get multiple opportunities to collect premium. So even though the stock has backed off about $1 since we put on the trade, you will be pleasantly surprised to see that the trade itself is now worth $3.25. We started at $3.57, and now we're at $3.25. So even though the long option, because it's a 5-lot, we have a 5-lot default here, and I think we're going to change that to a 1-lot so you can see the individual profit and loss. So it's not 5 at a time, because I want you guys to decide for yourself the kind of quantities that you want to trade. Even though the option that we've sold, even though the option we purchased is down $400, which could be temporary, right? Because the stock could start going back up. We've actually made $242.50 on the short option. That option's only 9.5 cents, and it's over $1 out of the money with 2 days to go. So chances are pretty good that that option will expire worthless. Now, what are we going to do on Friday? On Friday, we're going to look at this situation, and we're probably going to buy that 93 call back, most likely at a penny or two, and roll the option to either next week's 93, or if we're not feeling as bullish for next week, we could drop that strike price down to 92.5 or even 92, but 92 is starting to get a little aggressive. So we'll have to see exactly what's going on at the time. Okay, so that's where we're at. You're going to see a lot of this on, whoops, what just happened here? Oh, I got a little thing drawing here. I got to get rid of that. How do you get rid of that? Well, I apologize. This really was not behaving the way that I had expected today, and I apologize. Like I said, we're still working some of the kinks out. But the strategies are valid. They're strong. They're well thought out. And as you go through these twice weekly webinars, what I'm hoping is that things will start sinking in, and you'll start saying, hey, I think I can do that. So I want to practice that in a paper trading environment, or I want to take a small exploratory position in my live account. Okay, so that's where we're at right now. We got the eBay, we got the JP Morgan. We're still holding on to the VALE. And we put this on for $1.08. Now it's trading at $1.25, so we got a nice little profit. Okay. It is a $2 spread, so we're looking for a double here at some point. This stock has been as high as 960 as the metals have continued to behave well. I don't know if anybody caught what happened in Freeport yesterday, the XME, what's happening in gold, some of the other industrial metals. There's something brewing here, folks, in the marketplace that I think we got to pay attention to. All of a sudden, there's glimmers of activity in the oil service stocks, the oil exploration stocks, not necessarily the major integrated oils like Exxon and Chevron. They're still lagging, but something is going on here. Could be the start of rotation or the continuation of the start of a rotation or the development of a rotation into these kind of stocks. So pay very, very close attention. Bull markets, by their nature, can continue to run even if some of the favorite companies like a Google or an Amazon or the FANG stocks, as I mentioned in the newsletter this weekend, rotation is not a terrible thing relative to the other thing, which is the money leaving the market. Right? We don't want that to happen. We could have the money move around within the market and have different groups lead and lag, and we'll take advantage of that with our keen eye, and we'll try to take advantage of it with our keen eye and our strategies. But we're going to have to pay very close attention to that. So just to let you know that I'm out there watching this stuff every day for us, always looking for ways to put trades in this educational portfolio so that you can experience along with your course exactly how the concepts are implemented, how you can implement these concepts in your own trading. But as I said earlier today, just doing these credit spreads can be a little daunting right now because, and I quote again, the current low volatility environment is a dilemma for option strategists with long volatility exposure to time decay and small underlying movement, while short volatility is too cheap to sell. So on that note, I'll say goodnight to everybody. If there's any questions, you can ask them right now, put them in the chat box, and I'll type my answer in there. All right, if we don't have any questions tonight, everybody, good trading. Thanks for joining us. And we will see you tomorrow. We'll see you on Monday, but make sure that you pick up the newsletter on Sunday. Good luck the rest of the week.